Thursday, March 8th, 2018, Monaco 64, home of alternative economics and contrarian views. So it's before 8 a.m. I'm going to quickly look at the markets first, and then I'm going to talk about the current hot subject, which is free trade, globalization, the critics of free trade. There's a lot of myths out there, and I want to try to give my opinion with hard facts of what's really going on. But so before I go into that, just a quick look here. Spot gold is at $13.28, up $2.50. The range has been $13.30 to $13.23.50. We're still within that triangle or flag, if you want to call it. Yesterday was a pretty gold gave up quite a bit of its gains, but nothing's changed in reference to my video from yesterday about gold. Silver is up 4 at 16.55. Range has been 16.44 to 16.58. So fairly narrow ranges here this morning. The Dow is up 17 points, 24,807. Earlier in the day, we got down to 24,757. So fairly quiet as well. S&P future is unchanged. So that's really quiet. NASDAQ is up 16 points, up 0.25%, the NASDAQ future. The pound is up 12 pips at 139.06. Euro is virtually unchanged, 124.08. And the dollar is down 12 pips or 0.12% against the yen at 105.95. In terms of events today for the fiat markets, if you want to call them, we've got the ECB meeting today. I think people are going to focus on what Draghi has to say about forward guidance, but I don't want to get too much into that. So yeah, lately there's been a lot of talk about the tariffs, the stock market, how it's going to hurt the economy. It could cause an economic contraction globally. And one thing that made me laugh was an article yesterday. Not the article itself, but the parts of the article. It says, and I quote, "The last Jedi has fallen. Wall Street reacts to Cohn's departure." So we've got all these people from let's say Citibank, UBS, some Rabobank, hedge funds and private equity, all Wall Street people criticizing the Trump administration. And I'm not defending the Trump administration. I'm just trying to make a point here. They're all criticizing the tariffs, that it's going to hurt the economy, that we need free markets and free trade. And I think the subject of free trade and free markets are a little different. I have said in the past that the reason for the imbalances in world trade is because of the fiat money system. And I think it's been done by design by the globalists. And I'll show you why in a minute. And why am I saying it's being done by design? Well, because it sucks all the jobs out of the West, North America, Europe, into the to the less developed countries, the poorer countries. But you see, the bankers don't mind that because they've also opened up the financial system. Even China is opening up now the financial system. So the bankers don't care where the jobs are as long as they can deal globally. They don't care if people lose their jobs in the factory or wherever, in the US or in the UK or in France or Italy. As long as they make their profits and capital moves very easily, but financial capital, but real capital hurts people. So that's what's been happening, and This also, the fact that Trump wants to work on this dispels the myth as well that the U.S. economy is doing really well, that there's low unemployment. Because if the U.S. economy was doing so great, as he says, unemployment is at 4.1%. You know, and like Wall Street says, higher wages are like causing inflation, which is another myth. Why would he be so adamant to put these tariffs through to get more jobs into the U.S.? So that's another thing. I mean, even Trump, there's an article here from March last year. It says, Trump says 94 million Americans are out of the labor force. That's true if you include teens and grandma. That's from Business Insider. But he's got a point there, Trump. I know it includes people from the age of 16 to 65, I think, to the retirement age. So it just goes to show when people say that the tight labor market is causing inflation is not true. But one thing I watched, a video I watched, and I'll put the link above to it in the cards and also below in the description, was a video by former World Bank President James Wolfensohn in 2010. And it's on YouTube. It's 51 minutes long. It's at the Stanford Graduate School of Business. And basically, this is what James Wolfensohn said. I read the description of the video. It says, James Wolfensohn, former president of the World Bank and CEO of Wolfensohn & Co., addressed Stanford Graduate School of Business students with details about his work at the World Bank during its transition years and how the equation between developed and developing countries is changing. Wolfensohn claimed that in the next 40 years, a global shift will see today's leading economic countries drop from having 80% of the world's income to 35%. So there you have it. You know, I think maybe Trump is aware of that. Am I saying that poor countries shouldn't be allowed to develop? No, but I don't think it should be at the expense of like bringing down the rich countries with the policies that we have today. Of course, as I said, the banks don't care. The problem is that you know, United States, Canada, Europe, you know, the economies have been, how can I say, a lot of the jobs and businesses have been sucked out of these economies, and people are having to borrow more and more to keep their standards of living. And who does that help? Well, the banks, of course, because if people borrow more, they make more money. So they don't care. And that's why, you know, I laugh when bankers say that, you know, the current system is great and that it's going to hurt the economy. You know, these are the banks, like I said, that were bailed out. Banks that they were bailed out in 2008 by the taxpayer in the Western countries. They were given special privileges like FSAB, FASB, the Accounting Standards Board in the US, has allowed these big international banks who have huge derivatives exposures, who would have brought them down in, you know, after AIG in 2008 and Lehman. They can basically, they've changed their accounting. You see, for example, if you have a portfolio, let's say of cryptocurrencies, and Bitcoin is trading at 10,000, you'd be able to actually put in your books, Bitcoin, I expect it to be at 100,000 in 10 years' time. So we'll mark it to 100,000. So your portfolio, instead of being like $1,000, if you had one Bitcoin, it's going to be like 100,000. And that's called mark to model, because you know, your model says that Bitcoin is going to be 100,000 in 10 years. And that's what the banks have been doing. And the FASB or FSAB has allowed them to do that. The other thing that's happened is that the BIS, our friendly bank in Basel, they've allowed the banks also to basically lie about how much derivatives exposures exposure they have. So from having over 1 quadrillion in OTC derivatives, notional amount, they only have about 600, 700 trillion now, which is a lie. So, and of course, these bankers, these banks, international banks, they are protected by the BIS and the central banks. And central banks, are they free market institutions? Do they really promote free markets? No, they're monopolies. So when I hear these people, talking about, for example, let's say Fraser King from Citibank says, while heavily trailed in the press, the market is still mourning the sudden departure of Gary Cohn, the White House's lonely Democrat, seen by some as the final bastion of tariff-free international trade. Alas, now the last Jedi has fallen. Trade wars in the galaxy far, far away now all seems an awful lot closer than before. And then Paul Donovan, UBS, chief economist. Voice of reason. The departure signals the defeat of anti-protectionism and reduces the influence of anti-protectionism. Any tax on trade in any country means consumers are going to be purchasing goods they would not choose to buy at prices that are higher than they should have to pay to subsidize less efficient companies. That's really not that simple. And if he really believed in free markets and free trade, his bank wouldn't be in business anyway. And yes, maybe things will get a little more expensive, but at least some jobs are going to come back and people are going to have jobs. So if you have a job paying $50,000 and something goes up in price a little bit, you're still doing better off if you had no job. So that's what they don't talk about. So that's why I take these comments with a huge pinch of salt. So yeah, and as I said before, I think the whole problem with the trade imbalances is the monetary system, the fiat money system. And I think it's been done on purpose, as you will see from James Wolfensohn speech if you listen to it. I can't go through it here because it's a long speech, but what the international bankers have been doing since Tricky Dicky, I'm not a crook, Richard Nixon, pulled the world out of a gold standard, is that all these trade imbalances are a symptom of the raping of the rich countries. It's like a global or world, how can I say, socialist, redistribution. That's what it is. And I think that's what Trump realizes. And there's a lot of forces against it, the bankers, of course, because prior to the gold standard being dropped in 1971, if you look at the trade numbers, trade was in balance everywhere, almost everywhere. And there was, of course, a few countries that had to devalue once in a while, but the U.S. didn't have these huge trade deficits. I mean, we saw yesterday the trade deficit number came in at, I think, 56 billion, which is more than expected. That will hurt GDP. But that's all it is. It's like a transfer of wealth that they're doing, in my opinion. If you enjoyed this video, please like, share it, subscribe to my channel if you haven't yet. You can also follow me on steemit.com and on Twitter, and I'll talk to you later. Bye.